Many investors imagine capital exiting all at once. That's rarely how it works. Liquidity exits in layers. Layer 1, speculative leverage. Layer 2, mid-cap rotation capital. Layer 3, retail enthusiasm. Layer 4, long-term allocators. By the time long-term allocators reduce exposure, the reset is already underway. The first warning signs appear in leverage behavior. If open interest declines while price stagnates, speculative appetite is shrinking. If breakouts repeatedly fail, momentum buyers are weaker. If volume decreases week after week, participation is fading. Markets are ecosystems. When activity slows, vitality drops. Crypto is especially sensitive because its valuations depend heavily on marginal capital. When marginal capital retreats, structure weakens fast. Crypto traders often behave as if this market operates independently. It doesn't. Crypto is downstream of global liquidity. When real yields rise, the dollar strengthens, equity volatility increases, credit spreads widen, risk allocation contracts, capital becomes defensive, and crypto, being high beta, feels it first. Liquidity contraction in traditional markets eventually reflects in crypto participation. You cannot evaluate crypto health without acknowledging macro incentives. Liquidity follows opportunity cost. If safer assets offer competitive returns, speculative capital retreats. This is not sentiment, it is capital efficiency. If you want to know whether liquidity is thinning, ask structural questions. Are new wallets growing meaningfully? Is on-chain volume expanding? Are altcoins outperforming sustainably? Is funding consistently elevated? Are ETF inflows persistent? If most answers lean negative, the system is compressing. Markets do not require panic to reset. They require only weakening participation, and weakening participation is quiet. Markets don't crash because sellers appear. They crash because buyers quietly disappear. If you only watch price, you'll miss it. If you watch liquidity, you'll feel it before it shows. And right now, something is changing. Most crypto participants measure health by one metric: price. If Bitcoin holds above support, they think it's bullish. If altcoins bounce, they believe the market is healthy. If Twitter is loud, they assume the cycle is intact. That thinking is naive. Because price can stay stable long after liquidity begins to thin. In fact, the most dangerous market conditions are not violent crashes. They are stable but hollow structures. Here is the uncomfortable truth. Liquidity does not leave loudly. It leaves gradually. And markets break when they become fragile, not when they become emotional. Retail believes crashes are caused by fear. Veteran investors know crashes are caused by fragility. Fear is visible. Fragility is structural. And structural weakness always forms before emotional collapse. To operate like a professional, you need a structural lens. I call this the liquidity compression cycle. Crypto is the furthest end of the global risk curve. It thrives when liquidity expands. It weakens when liquidity compresses. The cycle has 4 stages. Stage 1, expansion. Abundant oxygen. This is when stablecoin supply grows, ETF inflows accelerate, open interest expands steadily, funding rates stay elevated, altcoins outperform, and venture capital deploys aggressively. In expansion, price trends smoothly, pullbacks get bought quickly. Breakouts follow through, retail feels smart, narratives multiply, liquidity acts like oxygen, everything feels easy. But understand something, price strength during expansion is not intelligence, it is environment. Stage 2, selective strength. Concentration. This is where most people misread the market. Price doesn't collapse, it narrows. Bitcoin holds, Ethereum consolidates. Large caps remain stable, but small caps stop exploding. Mid caps stop trending. Speculative narratives begin to fade. Volume decreases slowly. Open interest stabilizes or slightly declines. This is not weakness yet. This is concentration. Liquidity begins clustering in safer assets. The system is becoming selective. Professionals recognize this as early compression. Retail interprets it as healthy consolidation. Stage 3. Compression. Energy loss. This is the dangerous zone. Price remains range-bound. Volatility decreases. Breakouts fail. Volume fades on rallies. Open interest contracts. Funding rates normalize or flip slightly negative. Stablecoin growth slows or flattens. Participation declines, but quietly. Here is the key. Liquidity does not vanish. It becomes inactive. Capital stops rotating. Speculators reduce size. Market depth shrinks. Order books thin, and thin order books mean this. Small imbalances cause large moves. Fragility increases without drama. This is how resets are born. Stage 4. Reset. The vacuum. When liquidity compression reaches a threshold, one catalyst is enough. It doesn't have to be dramatic. A macro headline, an ETF outflow spike, a liquidation cluster. In high liquidity environments, bad news is absorbed. In thin environments, minor shocks cascade. Why? Because buyers are absent. Markets don't fall because sellers are strong. They fall because buyers are scarce. The reset is not the cause. It is the consequence of thinning participation. There is a misconception. If price isn't falling, risk is low. Wrong. Risk increases when liquidity thins, even if price stays stable. Because thin markets amplify volatility once triggered. In deep markets, size gets absorbed. In thin markets, size creates imbalance. Liquidity depth is shock absorption. When depth shrinks, impact multiplies. This is why experienced investors focus on order book depth and volume trends. They know fragility grows in silence. Close your eyes and imagine a stadium. Full, loud, electric. Now imagine the same stadium half empty. The structure is unchanged. The seats are still there. The field is still there, but energy is lower. That's what thinning liquidity feels like. Structure intact, energy fading. And when energy fades long enough, one event can empty the rest. Let's stay disciplined. Liquidity thinning does not guarantee immediate crash. End of cycle, structural bear market. It signals fragility. Fragility increases sensitivity. Sensitivity increases probability of reset, but timing remains uncertain. Professionals don't predict exact timing. They adjust exposure based on conditions. Here it is. Price stability is not market strength. Participation strength is market strength. Once you internalize this, you stop celebrating sideways price action. You start asking, is capital still flowing? Is energy expanding? Is oxygen increasing or thinning? Liquidity is the bloodstream of crypto. And when blood flow slows, the body doesn't scream. It weakens quietly. Excel, cold continuation, fragility before fear. If part 1 was about recognizing thinning oxygen, part 2 is about surviving in thin air. Because here's the truth. Resets don't punish ignorance. They punish overexposure. And most investors are overexposed without realizing it. 11. Reality shock. You don't lose in the crash. You lose before it. Most people think losses happen during the drop. Wrong. Losses happen during complacency. When liquidity compresses and nothing dramatic happens, investors increase position size, add leverage to maximize range trades, chase small breakouts, rotate aggressively into mid-caps. Why? Because boredom creates risk-taking, and boredom is a liquidity warning sign. Sideways markets with declining participation are not safe. They are unstable equilibrium. An unstable equilibrium breaks suddenly. Professionals don't wait for confirmation from price. They act when structure weakens. 13. Framework. The professional response matrix. When liquidity compresses, professionals adjust across 4 layers. I call this the liquidity defense matrix. Layer 1. Leverage reduction. In thin markets, leverage is explosive, order books lack depth, slippage increases, liquidation cascades accelerate. A 3% move in thick liquidity might be noise. In thin liquidity, it becomes a chain reaction. Professionals cut leverage early, avoid cross-margin exposure, reduce correlated bets, not because they expect a crash tomorrow, but because fragility compounds fast. Layer 2, liquidity migration. When capital retreats, it clusters. From low caps, mid caps, majors, cash. If you remain in illiquid names during compression, exits become expensive. Thin liquidity magnifies slippage. Professionals gradually migrate toward assets with deep order books, strong spot demand, institutional participation. They position where liquidity survives longest. Layer 3, optionality. Increase cash is not fear. Cash is flexibility. When markets compress, capital with optionality has asymmetric advantage. Why? Because resets create volatility expansion. Volatility expansion creates opportunity, but only for capital that survived. Fully deployed portfolios become defensive. Flexible portfolios become opportunistic. Layer 4, patience discipline. Thin liquidity environments generate false signals, fake breakouts, shallow rallies, sudden wicks. Overtrading increases friction costs. Professionals trade less in compression. They wait for clarity, because clarity returns only after liquidity resets. Not every dip is a reset. Not every spike is recovery. True resets show specific structural characteristics. Understanding these details can help identify genuine market resets versus simple volatility. Volatility expansion after compression. First comes contraction, then sudden range expansion. This indicates imbalance finally released and can be a sign of a potential reset in the market structure. Liquidation clusters. When open interest builds during compression and then unwinds violently, that is structural cleansing. Liquidations flush leverage, and leverage flushes are reset catalysts that help restore balance to the market. Funding extremes. Deeply negative funding signals, panic positioning. Extremely positive funding signals, overcrowding. Resets often occur when positioning becomes one-sided in thin markets, leaving them vulnerable to swift reversals. Volume spike on downside. Low volume drift downward is weakness. High volume capitulation is cleansing. Professionals look for exhaustion, not just decline, to determine when a true reset may be happening. The participation test advanced. Beyond price and leverage, look deeper. Is on-chain activity expanding? Are new narratives attracting real capital or recycled liquidity? Is venture funding increasing? Are ETF flows sustained or fading? Liquidity drain often begins in the periphery. You'll see smaller projects losing traction, community engagement declining, influencer attention shifting. Narrative energy precedes capital energy. When attention fades, liquidity follows. The psychology of compression. Compression phases feel deceptively calm. No panic, no euphoria, just drift. This emotional environment creates three traps. Overconfidence, it's stable, risk is low. Impatience, I need action. Denial, nothing has changed. But something has changed. Participation. And participation is oxygen. Markets require new entrants to sustain structure. Without new entrants, structure weakens internally. Resets are not emotional explosions. They are structural collapses. Liquidity leaves before price moves. Fragility forms before panic begins. And survival depends on acting before the crowd feels it. Once you understand this, you stop trading headlines. You stop chasing short-term narratives. You start observing structural signals: breadth, participation, capital rotation, depth. Most investors experience resets emotionally. Professionals experience them mechanically. That difference defines longevity. If liquidity compression leads to reset, three paths emerge. Path 1, rotational recovery. Liquidity concentrates in majors. Altcoins remain weak. Selective uptrend resumes. Path 2, structural rebuild. Extended sideways accumulation. Volatility decreases again. New narrative forms slowly. Path 3, macro-driven bear. Liquidity contraction tied to global tightening. Capital exits risk assets broadly. Longer rebuild required. Notice the common denominator. Liquidity must expand again. Without expansion, sustained uptrends are unlikely. Markets do not trend on optimism. They trend on capital inflow. Imagine standing at the shoreline. The tide slowly retreats. No alarm, no warning, just less water. Tourists take photos. Sailors adjust their boats. The danger isn't the wave. It's misunderstanding the retreat. Liquidity retreat is the same. You don't need to predict the exact reset. You don't need to call a top. You don't need certainty. You need awareness. Is participation expanding? Is capital rotating outward? Is oxygen increasing or quietly thinning? Markets don't collapse because fear arrives. They collapse because liquidity leaves, and liquidity always leaves quietly first.